Hello, everyone. Luke Gromen, FFTT. Hope everybody's had a great weekend and is getting off to a good start in the new week. Wanted to jump right into our weekly update here. First question is from CS. Is there a quantitative trigger level that the Fed is looking at in order to determine that the current inflation expectations have become unanchored and would necessitate kicking off their rate tightening cycle before their employment mandate was hit? It's a great question. Inflation using home price appreciation instead of owner's equivalent rent would suggest that CPI is already running over 10%. And in my opinion, the inflation level would have to be so high that the average citizen on the street not only knew that the government was lying but about inflation, but that it was high enough to actually drive a political response. And even then, I still think the Fed would be slow on the trigger because I think they're subservient to delevering the U.S. government balance sheet at this point. So I suspect there is a level where that happens, but I think we're still a ways from there. From SJ, what is the Fed catalyst to pivot from tapering, less easing, to pedal down or more? Is it winter/COVID flare-up? In my opinion, it's a 15% risk off in the stock market, and I think accompanied by a rise in treasury yields as stocks fall would be the biggest one. I do think there is a decline. If the economy got too soft, maybe that could reverse it as well. But to me, given how critical rising asset prices are, I think it really is around seeing how asset markets respond to what they're doing. From BD, so it appears taper will begin in November, December. With permanent reverse repo and the FIMA swaps, what will be the market reaction? I would assume negative initially until they realize inflation still runs and liquidity is still flush. Then a resumption of asset rallies? I'm not sure. In my opinion, the most likely reaction, particularly if they have the standing repo facility in place with those other facilities, is no reaction. Because ultimately, there'll be, if that's the case, there's no reduction of liquidity. In effect, dollar liquidity will still be increasing. Taper will be happening, but there'll be still increasing liquidity. If there is insufficient alternative liquidity, in terms of those alternative channels in place, at the time of taper, then I do think you could have a brief risk off. From LF, is there still a play in technology with low interest rates, or do you see bigger opportunities with industrials commodities? Yeah, I still think that real rates in the U.S. have to get to -10, -15% or more. I still think tech does well in in that setup. I just think in view of the inflation that has become, I think, higher conviction. I think the opportunities with industrials and with, in particular, energy commodities, electric vehicle related commodities, are just better. That's all. Than big tech at this point. From BF, how do you foresee the idea of stagflation coming versus hyperinflation? Can it be stagflation first, then hyperinflation? Also, what do you make of the idea that the U.S. government has demonetized gold? In my opinion, a currency destroying hyperinflation in the U.S. is very unlikely because at a high enough price, the U.S. can produce virtually everything it needs. If you look at these countries that had currency destroying hyperinflations, they tended to be smaller countries and couldn't produce what they needed at any price, hence the currency destroying hyperinflation. I do think Bitcoin could hyperinflate versus the dollar, which is, in my opinion, what Jack was referring to this weekend. It is important to note that Israel had a modest hyperinflation, if you will. Inflation peaked at 400% per year in the early 80s for a brief time as a way of reforming pensions, delevering the sovereign balance sheet, etc. To me, stagflation seems to be the most likely outcome, but with a few things going wrong, I think you could see a quote-unquote modest hyperinflation a la Israel in the early 80s in the U.S. If you interrupt supply chains for a long enough time and continue monetary stimulus for a long enough time. I agree that the government has demonetized gold. You can see it de facto has happened over the last 40 years. Will it be remonetized? There are foreign central banks that look to be trying to move gold back into the system as a reserve asset. That's how I would define it. But it has been removed from the monetary system as a reserve asset up until just recently. So I think de facto that has happened. From KA, share structure of the Bitcoin ETF BITO. Can BITO wag the Bitcoin dog? The crypto exchanges stay unregulated, so institutions won't touch physical Bitcoin. FINRA allows IRA money into BITO and it's SIPC protected. BITO increases shares instead of allowing share price to increase, thus horizontal sterilizing fund flows. Throw in a few well-timed exchange hacks to push people into insured BITO. I think it's possible. I think we need to be cognizant of it. I've just started reading the BITO prospectus. It's cash settled futures, and so that certainly raises that potential issue. Ultimately, though, I think the decentralized nature of Bitcoin, and importantly, the fact that it's way easier to buy Bitcoin on Coinbase than it is to set up a brokerage account and buy BITO through the ETF. And then perhaps most importantly, the ease of taking delivery of physical Bitcoin, if you will, during any potential futures sell-offs. I think it makes it a very different animal at this point than GLD. So let's watch and see, but I'm not that concerned about it at this point. Mechanics of a gold revaluation. Had a number of people ask about that. The mechanics are pretty straightforward. They're detailed in the Federal Reserve Accounting Manual as it was updated in July of 2021. Treasury instructs Fed to buy gold at a price. As Fed buys gold at that price with printed money, the Treasury's gold is revalued higher. That revaluation amount gets deposited into the Treasury General Account, or TGA, and Treasury has total discretion over how it wants to spend that TGA. If it spends that TGA into the economy on different projects without a commensurate rise in debt, that will significantly increase U.S. GDP, probably primarily through a nominal increase with very high rates of inflation. But ultimately, that would then allow GDP to rise a lot. And were that to happen, you would de-lever the U.S. government's balance sheet. That the GDP would go from 125% to 70% or something. And at that point, the Fed could begin to normalize rates. So I think that is that's the mechanics of how you would do it, and it would work. From MH, doesn't a gold revaluation significantly benefit our adversaries who increasingly hold gold? It depends on who you think are our adversaries. It's complicated. High gold prices. Gold's a neutral reserve asset. So a neutral reserve asset, a high-priced, big in terms of market cap neutral reserve asset, is bad for certain elements of Washington, D.C., and bad for certain elements of Wall Street. It's very good for Main Street America. It's very good for the U.S. military. It's very good for the rebuilding of U.S. defense and industrial infrastructure that have been completely hollowed out by the strong dollar mantra of the last 40 years. Right now, the U.S. military and a lot of critical components is dependent on China to source the U.S. military. And you have to ask yourself, if China is an adversary, would an adversary supply the United States with defense goods in a war against that adversary? And the answer, of course, is no. High gold prices certainly, I agree, would be good for Russia and China in terms of their mark-to-market profits on gold and in terms of changing the system away from the dollar system. But the dollar system of the last 20 years, nobody's loved it more than China. Who's won more than China under the dollar system of the last 20 years? Nobody. Washington, D.C., Wall Street, China love the dollar system as it's been structured. So if you change the dollar system, I don't think China's necessarily going to love it. So that's why I say it's complicated. So to me, bottom line on net, gold revaluation benefits adversaries tactically from a mark-to-market trading standpoint in FX reserve balances. But it doesn't benefit our adversaries strategically. Bitcoin could be used in this way as well. But ultimately, a revaluation of a neutral reserve asset much higher means the United States is going to start rebuilding its own defense, its own industrial base. And that is really good for the United States strategically, really bad for our adversaries strategically. And so, we'll see from there. So, great questions as always. If you're interested in what we're up to, you like these updates, check us out at FFTT. llc.com. Follow us on YouTube as well, at Luke Gromen, the YouTube channel, if you like these updates. That's where we're going to be posting them going forward. You can find out more information about tree rings and our other products on our FFTT-LLC.com website. In the meantime, everybody have a great week. Thanks again for joining. Look forward to talking with you soon. Take care, everybody.